Welcome to the Pirls Stock Market Commentary video, your weekly window on stock market technical conditions, featuring the proprietary bull-bear point and figure market breadth summary chart for September 23rd, 2018. Market breadth. With this past week's market fractional advance, our bull-bear point and figure ratio at 0.77 fell from 0.98 last week. The total count of securities in bullish or bearish patterns increased 8% to 3,301. The count of bearish stocks increased 20%, while the count of stocks in bullish patterns decreased 5%. The Pirls P&F market breadth summary chart shows us a market now 3 weeks in bearish territory. Paid subscribers have access to the OpenOffice Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To receive the weekly Pirls Stock Market Commentary via email free of charge, simply enter your name and your email address in the spaces provided and click Subscribe. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, fell 61 points for the 11th decline in 15 weeks. At a positive 102.90 points, it continues below all 8 tops above plus 100 in the last 30 months, and it continues above all 4 bottoms below minus 100 in the last 30 months. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in distribution mode, with average daily volume higher than the prior week. In the last 2 weeks, the Nasdaq had 3 accumulation days and 3 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in neither accumulation nor distribution mode, on lower average daily volume. Momentum. The CCI 20 daily, now at a positive 17.80, fell from a positive 40.62 last week. At Thursday 9/13 close, the CCI 20 daily formed a new zero-line reject long entry trade. At Monday 9/17 close, the CCI 20 daily fell below the pivot point, signaling our trade exit. The result of this trade simulation was a loss of 122.59 points on the Nasdaq, or $3.17 per share of QQQ. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 125 weeks ago, while the daily CCI 20 began a Woody's uptrend 10 weeks ago. The CCI 20 weekly fell to a positive 98.59 from 101.04 last week, continuing outside the plus or minus 50 range required for a valid zero-line reject long entry signal. Industry rotation the last 2 weeks. All of the top 5 industries are positive and only 2 of the bottom 5 are negative. Summary: oil services, gold and silver, and oil on the top. REITs, S&P Retail, KBW Bank, and some tech on the bottom. Bullish: computer hardware has left the bottom 5. Bearish: disk drives continues in the bottom 5. KBW Bank has entered the bottom 5. S&P Retail has left the top 5 and entered the bottom 5. Gold and silver and oil services have left the bottom 5 and entered the top 5. Focus this week from the South China Morning Post. Can U.S.-China trade war rivalry reverse the worst economic trends in both countries? By Andy Z. The following are some key points. The door for compromise and restoring a functional relationship between the United States and China appears to have closed. The 10% tariffs on U.S. $200 billion of Chinese goods, rising to 25% from January 1st, is the final straw. There will be more negotiations to come. At some point, there may be announcements of compromises and a positive outlook. But for now, the reality is that China and the U.S. have gone into rivalry mode, a rivalry that will define the 21st century. The U.S.'s contention is that China makes money from the U.S. and is using it to push America out of Asia and elsewhere. It is difficult to see how the U.S. could climb down from this position. To follow its rhetoric, it will try to cut off China from its market and block technology exchanges. This rivalry may bring short-term pain to both nations and to the world, but it may prove beneficial to all in the long run. Financial speculation and corruption have become normalized around the world. The titanic rivalry between the world's number 1 and number 2 economies will put all on their toes. Some of the most egregious trends could be reversed. The short-term pain is quite visible in China. Its stock market is plummeting, and the property market is on edge and may soon follow. It would be wrong to blame it on the trade war. China's stock market bubble didn't fully deflate in 2015. The government used multiple instruments to prop up the market, and it was trying to revive it with a tech bubble. Hence, the market has never reached a sensible valuation. Tech concept stocks came down from a 10-mile high to a 5-mile high, but never touched the ground. What's happening to the stock market should be viewed as unfinished business from 2015. The trade war was merely a catalyst. Property is the big one among China's bubbles. Its bursting would have a major impact on the construction industry and, more importantly, local government finance. The current monetary easing is clearly aimed at shoring up the market. There could be more supporting measures to come. Don't blame the trade war. China's economic slowdown is homemade. Due to China's hinterland effect, the efficient part of China's economy is as export-dependent as the other East Asian economies were. The U.S. has suffered little from the trade war so far. The damage to farmers from declining soybean prices is the most visible aspect, and the government is coming up with money to cover their losses. The U.S. stock market has been very resilient despite lofty valuations, rising interest rates, and the trade war. The key support seems to come from stock buybacks, thanks to Trump's tax cut and tax amnesty for repatriating offshore profit. I believe the tax cut is merely delaying the market's fall. The delayed timing, though, has emboldened the Trump administration to pursue the trade war. The big cost will come if and when supply chains are moved out of China. The process is inflationary. It is not just inflating the U.S. $500 billion of imports from China. Imports from other countries will also rise due to less competition from China. It will also force the Federal Reserve to raise interest rates more than expected. The U.S. has been experiencing one bubble after another for the past 2 decades. The low interest rate justified by imported deflation is the main culprit. The U.S.'s bubbles seem resilient for now. They will soon follow China's and burst. Bubbles bursting is a necessary condition to bring sense to all players. Policymakers have been paying too much attention to asset prices. The world needs a new generation of policymakers who don't hobnob with billionaire speculators and who understand workers' concerns. Unfortunately, the change will not come smoothly. Political turmoil in the West is very much about this. A heavy price has to be paid to bring about the change. The Sino-US rivalry is the main driving force to bring about the needed global change. The Beijing Wall Street axis has been driving the global economy toward speculation and inequality. As in everything else, competition enhances efficiency. At the end, both China and the U.S. will become better countries. Thank you for watching this week's Pirls Stock Market Commentary video featuring the proprietary bull-bear point and figure market breadth summary chart compiled by Donald Pirl, www.s2pmarketsignal.com. For Pirls Stock Market Commentary, I'm Cynthia Pirl, hoping that you have been enjoying a peaceful and pleasant weekend, that you are looking forward to a prosperous and productive week coming up, and wishing you true success.